welcoming you all to Skilled MBA Case Study Series in Accounting Japan. Industrial Partners orchestrated a $14 billion leveraged buyout of Toshiba, marking a pivotal moment in Japan's corporate landscape. This deal aimed to address Toshiba's financial instability and strategic misalignment. The buyout involved complex financing mechanisms, reshaping Toshiba's capital structure and governance, while considering strategic alternatives to ensure sustainable growth and stakeholder alignment. Toshiba faced a corporate crisis, necessitating restructuring. The $14 billion leveraged buyout was structured with intricate financing, employing leveraged buyout valuation methods and a complex capital structure. Stakeholders considered strategic alternatives, impacting governance. This landmark deal reshaped Toshiba, highlighting the challenges and opportunities in managing corporate turnarounds. Toshiba, once a symbol of Japan's post-war economic miracle, faced a downfall marked by accounting scandals, revealing $1.2 billion in inflated profits over 7 years. The crisis deepened with Westinghouse's bankruptcy in 2017. Shareholder activism intensified, with foreign investors demanding significant restructuring to restore trust and stability. The $14 billion deal marks one of Japan's largest leveraged buyouts, with 70% debt financing secured against Toshiba's assets and future cash flows. Japan Industrial Partners, alongside Japanese financial institutions, provides the equity portion. Post-deal, Toshiba aims to restructure, moving away from public market pressures to concentrate on core competencies. Leveraged buyout valuation involves forecasting Toshiba's future unlevered free cash flows over 5-7 years, including a terminal value. Adjusting the discount rate to reflect a debt-heavy capital structure increases the financial risk premium. Exit multiple estimation projects enterprise value at exit, typically in 5 years, using comparable multiples or discounted cash flow. Returns analysis calculates expected internal rate of return and cash-on-cash multiple, stress-tested under various scenarios. Capital structure transformation involves shifting from a conservative pre-leveraged buyout structure with 85% equity to a post-leveraged buyout leverage structure with 65% acquisition debt. This results in a 55% reduction in equity and a 53% increase in debt leverage, enhancing potential returns for investors through financial engineering. Private equity firms identify undervalued assets with strong cash flow potential. They structure deals by optimizing the debt-equity mix to maximize returns. Operational improvements focus on cutting costs, selling non-core assets, and enhancing efficiency. The exit strategy involves selling to a strategic buyer or pursuing an initial public offering at a higher valuation. Japan Industrial Partners offers $14 billion, focusing on restructuring through a domestic consortium. Bain Capital bids $13.5 billion, aiming for global expansion as a foreign private equity firm. KKR proposes $14.2 billion, emphasizing technology with Japanese partners. CVC Capital offers $13.8 billion, targeting operational efficiency as a European private equity firm. The value creation roadmap begins with streamlining management and divesting non-core businesses in year 1. Refinancing expensive debt is crucial. In years 2 to 3, focus shifts to investing in high-margin segments and expanding infrastructure. Strategic acquisitions are key. By years 4 to 5, optimizing operational metrics and positioning for an initial public offering or strategic sale aim to maximize earnings before interest, taxes, depreciation, and amortization multiples. LBO sensitivity analysis focuses on achieving a target internal rate of return of 20% and a multiple on invested capital of 2.5x over a 5-year holding period. The exit multiple is projected at 7x enterprise value earnings before interest, taxes, depreciation, and amortization, ensuring a robust return on equity investment. These metrics guide strategic decisions, aligning with the planned investment duration before exit. Corporate governance in Japan involves navigating national interest considerations, especially regarding foreign control of strategic assets. Companies in sensitive industries face special review processes. Effective stakeholder management is crucial, balancing the interests of employees, customers, suppliers, and investors, while respecting Japan's cultural emphasis on long-term relationships. Transitioning corporate culture requires adopting private equity discipline and performance-based management systems. Assessing debt service risk involves evaluating the ability to meet interest payments and covenants. Operational execution requires implementing cost-cutting and efficiency measures. Market conditions, particularly semiconductor industry cycles and global demand, are crucial. Talent retention focuses on keeping key technical and managerial talent to ensure stability and growth. Boards must balance long-term vision with short-term pressures, as public markets often focus on quarterly results. Privatization can offer a strategic retreat for restructuring. During transitions, boards have a fiduciary duty to ensure fair processes and maximize shareholder value. In Japan, corporate governance emphasizes broader stakeholder interests, reflecting cultural nuances. Understanding LBO mechanics is crucial for financial analysts. Master the valuation and structuring techniques. Analyze stakeholder perspectives to assess deal quality comprehensively. Strategic thinking is essential. Delve beyond numbers to evaluate the potential for business transformation. This holistic approach ensures informed decision-making in complex financial landscapes. Thank you, and for further inquiries or support, reach out via mobile at +91 87553000795 or email at support@skilledmba.com. Visit our website at https://skilledmba.com for more resources and information.